Good evening. My name is Alfreda Norman, and I am Senior Vice President of the Federal Reserve Bank of Dallas, responsible for communications and outreach. And I have the honor of moderating our public town hall tonight with Rob Kaplan. And this is our third public town hall for 2021. Our format for tonight is Rob is going to start us off by sharing what's on his mind, and then we're going to open it up to you, our audience, to ask questions. There are two ways to ask questions. You can click on the Q&A button on your Zoom screen and type in your question, or you can click the raise your hand button and join the queue, and we'll call on you and you can unmute and ask your question. We do ask that you keep your question concise, your one question concise, so that we can get to all the folks in the queue. So now it's my pleasure to introduce Rob Kaplan, who is the president and CEO of the Dallas Fed. He's been in this position for our 13th president since 2015, and he represents the 11th Federal Reserve District on the Federal Open Market Committee and the formulation of monetary policy, and he oversees the 1,200 Dallas Fed employees. So Rob?
Thank you, Alfreda, and thank you all for being here. So let me talk a little bit about the economy. Obviously, in the last number of weeks, we've had a resurgence in COVID, primarily the Delta variant. This resurgence has been going on for the last number of weeks. It's having an impact, as we thought it might, on travel, hospitality, leisure sectors. And as a result of what we're seeing, I think it's likely at the Dallas Fed, our previous forecast for US GDP was approximately 6.5%. We will be revising downward our third quarter GDP estimate, so that our full year GDP growth estimate will be in the range of 6%. Some of the impacts also of this resurgence is it's likely to continue to slow the matching of workers with jobs. In that regard, the most recent August jobs report was not a surprise to us. We had been concerned that we would see a slower job growth figure. And it's our view that it wouldn't surprise us for the month of September to also see slower job growth. It's not that there's not plenty of demand for workers. The so-called JOLTS report just came out. We have a record number of open jobs in the United States. But the issue is fear of infection is having an impact. We continue to have approximately 3 million previous workers that were employed in February of 2020 who have left the workforce and are self-identified as retired. And we continue to have something like 1.25 million people who've left the workforce to be caregivers. So we've got supply issues. We've got plenty of demand for jobs, but we've got supply demand issues. And there's a matching process that we knew would be time consuming, but I think the resurgence, it wouldn't surprise us, slows that matching process. We continue to see supply demand imbalances on materials. I just mentioned we see supply demand imbalances very pronounced on labor. And as a result of that, it's our view at the Dallas Fed that the PCE, headline PCE reading will be in the range of 4% for this year. It could be actually a little higher. And we now believe PCE headline inflation will be in the range of 2.6% for next year. We believe, having said all this, we believe the economy is recovering. There'll be some near-term slowing, particularly in the third quarter, but our estimate for growth in the fourth quarter is unchanged, and our estimate for growth for next year is unchanged, which is approximately 3%. And so our overall outlook is basically the same, but with some near-term weakness. We're expecting that because of the Delta variant and COVID, the economy is continuing to recover, but in fits and starts. And we're in the middle of one of those fits right now. We've got many more tools than we did a year ago. We've got vaccines, we've got booster shots, we have the use of masks and other tools that are helping businesses and consumers get back to their lives. So the one thing we note very significantly, despite the resurgence, we track very carefully this high frequency mobility and engagement data. And what we're seeing is mobility engagement is not improving over the last several weeks, but it's also not deteriorating. And we're struck by the resilience of the consumer. People are adapting and learning to manage through this. Businesses, in the same way, are adapting and learning to manage through this. The one thing we hear, though, consistently from businesses in every conversation is there's supply-demand imbalances for materials. And if anything, I think businesses think those may last longer than they'd expected. And we're continuing to hear very pronounced challenges in hiring workers, the need to pay more for wages for workers. We're hearing stories about higher absenteeism. We're hearing more stories about workers being reluctant to come back into the labor force. And all these things are creating strains for businesses in hiring employees. If you're a big business, you've got a number of tools you can use and levers to manage it. You got scale, you got technology. If you're a mid-sized to small business, on the other hand, you don't have that many levers. And the only thing you can do is adjust your operating hours or production runs and raise your prices. And we are hearing broadly across businesses that they are not only raising prices, that they are confident that they're going to continue to raise prices, and they're more confident that those price increases are going to stick. So that's a mouthful. So let me stop there and let's go to discussion and questions.
Well, as you know, we do take questions ahead of our time tonight. So I've got lots of questions. We've got a lot of things that people are thinking about, but I also want to remind our audience that you can type in a question now if you click on your Q&A, or you can click the raise your hand button to ask a live question. So let me start with where you started talking about COVID. And one of the things that someone wrote is, if the economy shows persistent signs of slowing due to the Delta variant that could last for longer than, say, 2 consecutive quarters, with monetary policy already highly accommodative, what tools does the Fed have left to bolster the economy?
So it is not our expectation that you're going to see a prolonged slowing. You're going to see a slowing in the third quarter. It's our expectation you're going to see some improvement in the fourth quarter. I also would note there is still a substantial amount of fiscal stimulus money in the system. So what's a good example? The American Rescue Act. There is substantial amount of money in cities, in counties, as you and I have talked about, and we've talked to county and city officials. They've got billions of dollars that they need to spend between now and the end of 24. The SNAP program, food stamp program payments are actually increasing. They're being extended. There is plenty of fiscal stimulus based on what's just been passed so far in the economy. So my own view is you've got quite a bit of tailwind, but we have to still manage through this virus. I would also note that while we're getting used to growing this year at, say, 6% plus or minus, potential growth for the U.S. economy is still, in our view, much lower, 1 3/4 to 2%. So the issue is, some people are worried, gee, growth is going to slow to only 3.5% in the third quarter, and maybe it'll rebound to 5 or 6% in the fourth quarter. Those are, in our view, not sustainable growth rates. Those are above trend growth rates. Growth of 3% next year is above trend growth. We are ultimately going to gravitate back down to 2% GDP growth. It's going to take us probably through 22 and 23. And so I'm not alarmed by if you see a slowing over the next couple of years down to 2%. It should be expected. The part that's unusual is how far above trend we're currently growing. I'll make one last comment. If you go back to pre-COVID, demand growth is now caught up and surpassed where we would have been in demand growth if we had been kept growing at 2%. So in other words, we're outstripping where we would have been. Overall GDP, we've now caught up, and we're on the verge in the next couple of quarters of catching up to trend GDP growth. So there's a lot of strength in the economy.
You mentioned being resilient. It sounds as though the economy is resilient in all of this pandemic, which leads us to the next, a lot of questions around tapering. When will it begin? What speed? What, if anything, do you look at signals from the economy, from our region particularly, would give you cause to believe that a change in interest rates or accommodative of the Fed should change? What are you thinking, or what are you seeing around tapering?
So we're buying 80 billion of treasuries and 40 billion of mortgage-backed securities every month. These purchases were very well suited to 2020. They're very well suited to early 21 before we had widespread vaccinations. They're very well suited to stimulating demand. The issue is, as I see it now, we still have very strong demand in the United States. It's been a little bit dented and will be dented in the third quarter, but it's still very strong and above trend growth. And the issue we have is we've got a range of supply issues. And so I've said, and you've heard me say publicly several times, I think these purchases are not particularly well suited to the situation we're now facing. And we have to keep in mind that the Fed has a commitment to anchor inflation at 2%. And right now we're running well above, and we expect to continue to run meaningfully above next year. And we see a broadening on some of these price pressures. So I've been saying for the last number of weeks and months that I would like to see us begin to adjust these purchases. I'd like to see us do it gradually, say over 8 months. And the only thing I would say, I'll be watching very carefully how the economy is unfolding between now and our September 22nd meeting, and still confirming and reconfirming the trajectory of the economy and assessing whether there's any fundamental change to the outlook. As I see it now, I don't see a fundamental change to the outlook. If I get to the meeting and continue to feel that way, I'd be advocating that we should announce a plan for adjusting these purchases in the September meeting and begin shortly thereafter, maybe in October. But that's a subject. We've got a range of views at the committee. We'll have a debate about that, and we'll hash that out in the September meeting.
I had a question about the stock market. The stock market it's at near or all-time highs. Based on historical PE ratios, the market seems overvalued. Is the Fed concerned that a steep correction in the market could have a negative impact on the economy or drive a recession similar to the .com or the mortgage-related recession in 2006 and 2007?
Yeah, so I'm not smart enough to know if the stock market is overvalued or where it is relative to where it should be. I would say this: people have moved out the risk curve and are taking more risk. In addition, I would note that credit spreads are historically tight, and even high yield credit spreads are historically tight. And so it would not surprise me over a period of time to see some normalization or adjustment in that. And I think that's probably to be expected. So I guess those would be my comments on the markets.
All right. Well, I'm going to also take a look at some of you have been writing in your questions. So I'm going to look at some of these that we have here, putting aside the health debate, is wearing a mask at this moment good for the economy?
I think it is good for the economy. I know it's a personal choice, but I would encourage people to get vaccinated. If you have the opportunity to get a booster shot, it's your time. I would encourage you to get a booster shot. And yes, a mask is a critical tool that we have. Particularly if you're in a classroom or other enclosed spaces, masks are a key tool that I hope we'll use and use extensively. And I know there may be some political sensitivity about it and some debate, but I don't think there ought to be. I think we are far more likely to keep our kids in school, keep our kids healthy, help businesses continue to reopen if we have broad use of mask wearing. And so I hope we will.
Another question that's been written is worker productivity increasing or decreasing? And what is your expectation for productivity growth in the future?
So, the productivity numbers recently have been better, but some of that may be a mix issue. So we know the service sector has not fully caught up. They tend to have a little lower productivity. The manufacturing sector tends to have higher productivity. And there's also a composition issue. So I think in fairness, it's too soon to say what the productivity trends are going to be. I do know this. We know that due to aging, workforce growth is decelerating in the United States. And in order to offset that, we would benefit enormously from greater productivity growth. How do we get that? One, early childhood literacy, skills training, Wi-Fi investments, and maybe investments in childcare, other things that help improve the ability to work and be productive. Infrastructure. I think it's very important in an aging society that we focus on ways to improve productivity.
Great. We do have a few folks with their hands raised, so I'm going to turn to Hank Mulvihill. Sorry, Hank, if I messed up your last name. Hank, if you could unmute at this time and ask your question.
Hank, you're still on mute. Nope. Go next.
All right. Well, Hank, if you figure that out, I've still got you in the queue. So let's go to Jason Leader. Jason, if you unmute and ask your question.
Thanks so much, and thanks, President Kaplan. With the matching issue that you mentioned, and also part of that's caused by retirements, and then also the absentee issue as well that you talked about, do you think where full employment might be higher than we kind of thought, or where you thought before?
I think the labor force is tighter than the headline numbers suggest. And so we're at 5.2% unemployment rate. But boy, everything we're seeing, I talked about retirements, caregivers, fear of infection. You mentioned absenteeism, which we talked about. All those things suggest, even for some people, what I'm hearing from employers, even for people that are employed on the payroll, the full-time equivalents, I'm hearing from some businesses that they're getting out of their workforce is lower. And absenteeism is one of those reasons. So all that suggests to me the workforce is tighter than the headline numbers suggest. And so I think that's a challenge, and I hear about it widely.
Thanks.
I'm going to turn to a question that was written in. I was recently at a restaurant where I ordered through an iPad. How much will higher wages cause small businesses to substitute capital for labor? And what are some long-term impacts on employment, productivity, and GDP growth?
I mean, I would guess every business I talk to, if they can, is looking to use technology to supplement workers or, partially get more leverage out of workers. And I think that's going to be an ongoing trend that's going to be with us for an extended period of time. The issue is for those businesses that can't afford the technology or have more challenges. It's not so easy to do that, but I think you're going to see that you're going to see the iPad and other technology interventions. That's going to be a fact of life, and that's going to be accelerating for those businesses that can do it.
Yeah. Let's see. I'm going to call on Eddie Allen. Eddie, if you want to unmute and ask your question.
A two-part question. One is, you see a lot of speculative excess in the markets, crypto, maybe leading to a lot of real misallocation of capital. They say 1% of world electric production is now going to crypto. Does the Fed have any specific tools it could use, like margin requirements, that it could use to maybe target the speculative excess in the markets? And secondarily, what do you think of crypto? Does it have a use in the real economy?
Well, the main thing on there's cryptocurrency, and then there's the digital currency. Cryptocurrency is crypto, I should say, is not tied to any underlying currency, where digital currency is explicitly tied to an underlying currency. And crypto is being used by people as, I guess, an alternative to gold, an alternative to paper currencies, a way to protect against maybe the deterioration in the value of paper currencies. And so it doesn't surprise me that people are doing that. Yes, is it speculative? Yes, it certainly can be speculative. I don't know that the Fed needs to be getting involved in discouraging people or making it harder for people to own cryptocurrency. I think to the extent that crypto started to get used more widely in payments, which has been more limited than it might be because of the volatility. I think that's something we would monitor and track very, very carefully.
Well, we've got an active crowd writing in their questions tonight, so I'm going to try to keep up with you, but don't forget, you can also click on raise your hand if you want to ask a live question. Sort of thinking about fiscal policy, let me ask you a question that someone had written in. Is there a total amount of U.S. national debt that once obtained can create economic instability and can jeopardize the U.S. dollar being the world's reserve currency?
Well, I'll put it this way. The reason we're able to run this level of debt to GDP, in other words, debt to GDP, in the neighborhood of 100%, present value of unfunded entitlements around 65 trillion and growing. The reason we're able to manage this is because the dollar is the world's reserve currency. And so people globally overweight to the dollar and allows us to finance this at an affordable way. The challenge, I think, is if we ever get to the point where, because of technology, emergence of other nations, there are a number of possibilities where the dollar is not the world's reserve currency, or people don't stop buying dollars, they just don't overweight to the dollar. That could make it more expensive for us to finance this. So my own 2 cents is, and I've said this many times, I think we'd be well served to not rely so heavily on the idea that the dollar will always be the world's reserve currency. I think it will be for an extended period of time, but I think we need to find ways to moderate our debt growth or debt to GDP growth. Obviously, we haven't been doing that in response to COVID, but as we come out of it, I think we need to find ways to grow faster, improve productivity. This is why we talk so much here about education and skills training. And we're going to have to find ways to moderate our debt growth also. We're going to have to do all the above. And I think we'd be well served to do that and not rely so heavily on the idea that we'll always be able to be the world's reserve currency. I hope we will, but I don't think we should count on it so heavily.
Yeah, I've got someone wondering, should we worry about our national debt issue? Should we be more serious about it at this point in time?
Well, I've been saying for years in pre-COVID, yes. And then COVID happened and we've just increased our debt to GDP. But the answer is, yeah, we will have to get back to that. I believe we would be well served to get back to that.
Yeah. Another question that's come in, is there a concern that the Fed could get boxed in if we have an extended period of persistent above target inflation and puts a drag on the economic growth?
So it's been my view, and I've said this, that I would love to see us sooner rather than later start taking our foot off the accelerator, because I think the longer we make these purchases for longer than necessary, I think it may actually make it so that we have less flexibility down the road, and don't have the luxury of being as patient on the Fed funds rate. And why would that be? Because of potential inflation issues down the road. So for me, I've specifically divorced considerations on asset purchases from the Fed funds rate. And people assume that, gee, you taper sooner, it means you're going to raise rates sooner. I don't think that at all. I think that by adjusting purchases sooner, it may actually give us more latitude to be patient and flexible on decisions we make on the Fed funds rate.
All right, we have another live question. Let's go. Let's see. I've got names here that look like screen names. So JGOYNE. If you want to unmute your name, and why don't you state your name for us? If you unmute.
Joe Goin.
Thank you.
All right, my question is this, Mr. Kaplan. As U.S. Treasuries mature, do you see the Treasury taking advantage of the low long-term rates and move more of the debt to long-term bonds by selling long-term bonds, which would, in my opinion, be the smart thing to do for the next generation?
So I'm going to be careful as a central banker not to intervene in Treasury planning matters. But having said that, I'm sure they're looking at it, and the arguments you just made are, I think, would be worth considering. But I'll stay out of that lane. But I think that argument, I'm sure, is one that they're considering the Treasury.
Great. We have another live question. It's your screen name. So I've got a last name of Toltenberg. So if you would state your name, unmute and state your name for us, so we know who you are and ask your question.
Wayne Stoltenberg.
Thank you, Wayne.
Hey, Wayne.
Here's my question, Mr. Kaplan. And by the way, appreciate your service to the Fed. I know you're not doing this obviously for a paycheck, so appreciate to have guys with experience doing this sort of thing.
Thank you.
I'm old enough to remember the Reagan supply side formula of a stable dollar, low tax rates, and sane/low regulation. And we had growth well in excess of 3%, or certainly in that ballpark for a number of years. You sort of implied that's kind of above trend, and I took that to mean may well not be attainable sort of in current environment in which we live in. Folks like myself and Larry Kudlow don't believe that. Could you tell us why we're wrong?
So your point is you think potential growth's higher, right?
With a stable dollar, lower tax rates, both corporate and individual, and a sane/low regulatory environment, particularly on the business side, yes, I do think 3% is possible.
So let me back up. GDP growth, as you know, is made up of growth in the workforce and growth in productivity. We know, for better or worse, workforce growth due to aging is decelerating. Okay, so we've got if you go from the 70s, the 80s, the 90s, 2000s, 2010, and on to today, we've had a steady decline in the rate of workforce growth. So we've got to make up for it through greater productivity. And to your point, there are many people that argue that tax policy, regulatory policy, maybe some would also say infrastructure, other actions, improving early childhood literacy, skills training are all things that could improve productivity growth. And so even though we've got sluggish workforce growth, it could be more than offset by improving productivity growth. So I get the argument, and you pointed out a couple of aspects, regulatory and tax. And I listen, we're going to have to find ways to grow faster, and we're going to have to find ways to improve productivity. And I could see the argument, and I've heard, I understand the argument for why the two things you mentioned might help improve productivity, which in turn would mean potential growth would be higher.
Thank you.
change gears a little bit. Here's a question. Given the recent natural disasters, how does the Fed think about climate change risk or climate risk, and how that feeds into the economy or needs to be measured or accounted for in the future?
So I don't need to tell you in this audience, living in Texas, we see the impact of severe weather events, whether it's hurricanes and the impact on the Gulf and infrastructure in the Gulf and refineries, petrochemicals, the cold freeze, severe weather event we had earlier this year, droughts, fires, et cetera, et cetera. Hurricane Harvey alone, I think our estimate was it might have cost something in the neighborhood of $70 to $80 billion. So climate change, severe weather events, and I think if you look at the governmental agencies, their assessment is that this is us consistently over the last several years, is that due to climate change, you're going to see a rise in water temperature, you're going to see more severe events, you're going to see a greater frequency of hurricanes. And as a result, that's tail risk that is going to potentially affect Texas and the US economy. And what we're seeing is these once in a blue moon events are starting to happen with greater frequency. So it's concerning. And our job at the Fed is to understand the economic impact of these severe events. We also monitor financial stability for financial institutions and take those severe weather events into account in thinking through economic potential in Texas and in the country. And we also do a lot of work at the Dallas Fed thinking about energy transition, meaning whether we like it or not, even if we have dramatic adoption of wind, solar, electric cars, and so on, battery storage, we're still going to be very reliant on the fossil fuels industry for many, many years to come. And so we're going to have to figure out a way, as we're aggressively moving to our alternatives, to still have a healthy fossil fuel industry in order to provide the needs of our population and to avoid these price spikes and other impacts like that. So we're looking at all those things, and we do work on all that at the Dallas Fed.
One of the questions that we had that was written in was asking about following the blackout and the natural gas crisis in Texas and in the South Plains in February. What is the status of weatherizing power generation and field level gas production and processing?
Well, I'll say it this way. I know for the governor, for the legislature, and for many businesses, it's a very high priority. And they're working intensively on realizing that we need to weatherize this infrastructure against extreme events. In the case earlier this year of extreme cold, it really was unprecedented. And I know a lot of work is being done in all those sectors to try to beef that up. And I'm confident that they'll make progress on that.
I had some questions about the housing market.
Yeah.
On the housing market, we're seeing housing prices increase at very high levels. What can the Fed and more broadly the government do to ensure that there is more affordable housing, because high prices disproportionately affect marginalized communities?
Well, in terms of creating more affordable housing, there's probably other parts of government that get more structurally involved in that. The part I'm looking at is and we do a lot of research on this, and we've written a lot on this at the Dallas Fed, especially recently, about the fact that elevated housing prices are bleeding into, with a time lag, higher rents. And these higher rents in particular, most significantly affect low, moderate income communities. And so this is one of the reasons why, again, I would like to see us sooner rather than later begin to adjust our treasury and mortgage-backed security purchases, because I think both have an impact on this, because these elevated home prices is rippling in, and our own estimates are it will have an impact on rents down the road, and those rents will particularly affect low moderate income communities. So we're concerned about that.
We have another caller, Robert Sakowicz. So if you unmute and ask your question, Robert.
Hey, Bob.
All right. Thanks for doing this, Rob.
Thank you.
Global shipping costs have increased fourfold, and container imbalances worldwide have totally disrupted supply chains, seemingly for several years to come.
Yeah.
What do you foresee as the impact on American investment in manufacturing and readjusting, or are they just relocating to other than China, closer to home locations? And the second part of that is, what's your longer term outlook regarding U.S. investment and trade with China?
Yeah, so I'll take those in reverse order. How's that?
Okay.
The issue between the U.S. and China is, in many ways, we're competitors and we're rivals. There's tension about technology transfer, intellectual property rights. And at the same time, there are a number of ways that our two countries can cooperate. The challenge is to walk down both those paths at the same time, to compete, to work out these difficult arrangements on intellectual property rights and technology transfer, and to find ways to cooperate. And how well is that going, or how well is that going to go? I'm not sure exactly, but I think it'll be in both countries' interests to be able to think in a dual way on that, because it could be mutually beneficial to both. But I think that these tensions are present. So then you get to what you asked about on containers, and listen, what I'm hearing, the global COVID situation is, as you said, delayed shipping, made it more expensive, made containers more expensive. And there is a greater push, and I'm hearing this in the United States, where we might have gone from a few years ago to just in time to in the lingo, just in case. I think people are more sensitive to having supply availability close by, even if they have to pay more for it. And this is probably an element of this is where Mexico also comes into play, and that it wouldn't surprise me to see more people looking at things that they do with China and find a way to, if they can cooperate more with Mexico. But this is an issue, and I'm hearing it pretty broadly. You'd like to believe as we recover and as we come out and do better against the pandemic, that some of these issues will resolve. But I will tell you, the estimate for the timing, I think, keeps getting pushed out.
We had another question about China, since we're on that subject. And this audience member wanted to know, what are the implications for global markets of the recent slowing in China? And what are the spillover effects to the US and the implications to monetary policy?
So China is a big part of global growth because they're a big country, and they've been historically growing at rates higher than the rest of the world. So the extent China grows more slowly means global growth somewhat slower, which, all things being equal, means US growth on the margin will be somewhat slower. It also, what's going on in China, particularly some of the COVID issues and other issues, affects global supply chains and global trade. So we're still, in many ways, very interdependent, and what happens there has an impact on the rest of the world.
We have another caller, Andrew Melnick. Andrew, if you would unmute and ask your question.
Hi.
Hi, Andrew.
From Goldman Sachs days, Rob. It's follow-up to the question. Historically, pandemic's worst period is not the first year, it's the second and third year. So in the United States, I'm not that discomforted because we have the vaccine, but when you look at Vietnam, where only 2% are fully vaccinated, and it's an important supplier of clothes and shoes, et cetera, it seems to me the Fed's outlook for transitory inflation, I don't think is taking into account the bumpy shipping and production that's likely for the next year or two. Right. Because as you know, the pull down in inventories are going to take a long time to rebuild if that's the case. And the potential for more than transitory inflation seems likely. Two, I agree with you on Mexico. The other thing may be, as you pointed out, and this is a banking issue, that in order to protect themselves, manufacturers will build their inventories, which is a working capital issue. Right. And three, most people don't realize one-day delivery is a major revolutionary logistics issue compared to 2 days. You can get stuff in 2 days from China. You can't in 1 day. Right. So we're going to see a lot of change. But my whole comment is that the pandemic is going to be longer and have more of an influence on shipping, inventory, and manufacturing, particularly in Asia, than I think many are given credit for.
Yeah, so you probably know from hearing me speak, I've been a reluctant to use the term transitory, and I've been saying, based on what I'm hearing from contacts, that these material supply demand imbalances are likely to last longer. You talked about global supply chains and logistics. Unfortunately, those issues are liable to last longer. And I think the labor supply demand issues are, if anything, getting more pronounced. And so I do worry that some of these price pressures, we're going to see a broadening in those price pressures. And I think that's reflected in our headline PCE inflation estimate for next year of 2.6%. And I think there's some risk to the upside in that forecast.
Jumping to crude prices.
Yep.
What's your outlook on crude prices, and how does the current and projected price of crude oil impact your viewpoint on GDP growth and underlying inflation?
So fortunately for me, part of my job is not necessarily to accurately predict crude prices, but I would say the following, and we do a lot of work on this. Let's say we ended last year with U.S. production, oil and gas production, say 11 million barrels a day. It's our own forecast that will improve somewhat this year, and we are, but it's going to be relatively modest. You know, maybe we'll go to 11.3, 11.4, something like that, which is not as great an improvement in net production as you'd expect given the firming in prices. And so why is that going on? As many in the audience know, those in the oil and gas industry have made a commitment to their shareholders that to the extent they have cash flow, they're going to be a lot more likely to return it to shareholders in terms of share repurchase and dividends, and less likely to put it in more drilling. And so, one of the challenges is going to be to continue to increase production. But we think that's going to be pretty sticky. So what's the impact on the price of all that? It's going to be a function of what OPEC does. So we went for a few years here where maybe the US was the swing producer and we had a big impact on the price. I think what we're seeing is US production is going to be more challenging to increase production. And so OPEC is now becoming much more influential on what happens with price, and it just depends on what decisions they make on what they want to do with production. So I don't know what they're going to do. I think the fact that U.S. production has been sluggish, I think maybe gives them a little more confidence that they don't need to increase production as much, and maybe they can let the price rise a little bit without stimulating too much more U.S. production and losing share. So what that means for prices, we'll have to see. But those are the dynamics we're watching.
Yeah, we're talking about oil, so that makes us think about Texas, of course. So is the general Texas growth trend, GDP, still trending up, or has it stabilized?
I'd say the recovery in Texas pretty much mirrors the shape of the U.S. recovery. So if we see a little bit of sluggishness in the third quarter, it wouldn't surprise me to see a little sluggishness in Texas in the third quarter. The difference between though Texas and the rest of the country is we've got a big tailwind in terms of migration and people and firms to the state. That's not an entitlement. People are still making judgments from around the country every week, either businesses, people and firms about moving here. But I'd say we've got the wind at our back in terms of migration and people and firms. And so what that does, it means we have faster population growth, faster workforce growth, which means all things being equal, we have somewhat faster growth than the rest of the country. And that's what we're seeing.
Well, thinking about households, we had a question that comes in that says, do you expect to see a reduction in household monthly discretionary income? You were talking about rent, but rent and mortgage. And what's your view on how the scenario will affect the average consumer, short and long-term growth and national growth?
So it depends on what segment of the consumer. So I do worry about low, moderate income populations that spend a bigger share of their wallet on gasoline, used cars, eventually if rents go up, rents. And so the price increases or inflation has a greater impact in terms of share of wallet. And then the challenge is, can their wages go up enough to keep up? I think by and large, a lot of what we're seeing across the board, though, is wage pressure. And so when you have wage pressure, that should translate into higher income. Then the question is, how do those wage increases and improvement in income compare with cost increases? And what's the share of wallet? And to the extent that wages are growing faster than cost of goods for a family, that's greater discretionary income. But I'm pretty optimistic about firming in wages. The thing that we're just going to have to watch is inflation, and where does it settle out?
Speaking of cost, there was a question about to what extent will the increasingly prohibitive cost of higher education inhibit economic growth long term?
Well, coming from higher education myself, that's an excellent question. It would not surprise me in the years ahead to see some pressure on tuition and cost of college. This is an industry where I could see there's going to be more competition. You've got online option. COVID has accelerated the online option. And so I think that's something higher education is going to have to wrestle with.
I wanted to change gears and talk about something that's happening. It's happening in Southern Dallas, but it happens across many communities across Texas and across the country. There is a investigative report out by a local television station that is exposing what they find to be systemic racism entrenched in the banking industry and how it fuels the racial wealth gap. And highlights of their reporting include modern day redlining in minority neighborhoods and bank branches in minority zip codes that take deposits but won't make loans. What's your response to this report?
So we see why this report is coming out. We are concerned about access to financial services in low moderate income communities. We're worried about and we're aware of a lack of lending availability. I think the PPP program, highlighted that there was disproportionate access depending on who you were and what kind of community you were in and whether you had a banking relationship. And what we're seeing in low moderate income communities, they don't tend to have They may be less likely to have banking relationships. And if that's the case, they may not be able to get financial services, either to borrow or and so on. And so we're spending a lot of time talking with the banks. We're spending a lot of time working on at the Fed modernizing Community Reinvestment Act. But we also, as you're a big part of this leadership, Elfrida, working with nonprofits to focus on either CDFIs or other nonprofits that help create more lending in these low moderate income communities and can partner with banks in addition to do more to create greater access. We got a long way to go though. And we've got a lot of work to do because, yeah, as this reporter has said, there's a lack of access and a lack of lending, and we've got to do much better.
Let's see if we have another call in, and I think it might be Eddie Allen again asking a second question. So
Okay.
Eddie, if you want to unmute and ask a question.
Yeah, I was curious, we have this $3.5 trillion package that's been proposed, which a lot has, stuff that could increase productivity, like early childhood education, reduce college education costs. But a lot, is maybe not, healthcare expansion for elderly and things like that. At the same time, it also has a higher corporate tax, higher tax on high-income individuals, but a lower tax on people under 400,000 in the proposal. On balance, what do you think? Is this a growth-enhancing initiative in the near term or long term?
So I'll be careful not to get into the specific legislation either on the spending side or the tax side. But I would say the following. I've been an advocate of improving early childhood education, access to childcare, things that help get people into the workforce and can improve their productivity. Some aspects of the infrastructure proposal, if it's well done, should help improve productivity. And what we've talked about is the fact, what I'm more skeptical about is government spending that would create a bump in consumption just to wear off and get back down to trend growth. And so things that improve our productive capability and our investments, either in human capital or other activities that are long-term and should help improve GDP growth. And we need to improve GDP growth. So I guess a lot of it would depend on what's in it and whether it's short-term stimulative to stimulate consumption in the short run versus an investment that you get a payoff over longer term and should help improve productivity. And I guess
what about the
tax side deliberately.
Okay. Well, it is notable. I mean, the early caller did note that low taxes had higher growth in the Reagan administration, yet our best decade since the 60s was the Clinton decade, when you actually increased corporate taxes and increased high income taxes. Do you see any evidence, one way or the other, whether taxes are necessarily stimulative or reductive?
I guess the short answer is it depends on the nature of it. I would say this, again, growth is going to get back to things that grow the workforce and investments or incentives, which could be tax incentives that encourage CapEx, investment in productive equipment, things that improve productivity. So that's without getting too much into the tax debate. I think that's what I'm looking for, things that actually improve productivity and business productivity are important.
Rob, one of the things that you've mentioned when talking about GDP is labor force participation. That's an important part of it. I wonder if you could comment on what is being called the she session
Right.
of women, particularly from COVID. that have had to really rethink about their employment?
So we've seen since COVID started a disproportionate drop in labor force participation among women, particularly women with children. Very different than the Great Recession, much more pronounced. And so what does it do? It highlights the fact, obviously, our kids in school, can schools stay open? Somebody earlier asked about a mask. Wearing masks widely in a school is more likely to keep them open and keep the classes from being sent home, which is happening. Access to childcare is also critical. And what we're learning due to COVID is that it's pretty challenged, access to childcare and affordable childcare. And the childcare industry is a pretty fragile industry. So I'm hopeful that some percentage of women who've left the workforce with kids will come back, but you're going to need in-person schooling, better access to childcare and affordable childcare. And by the way, how we deal with COVID is a key part of that equation, and using the tools we have at our disposal to battle COVID, I think will make it more likely that women are able to come back and stay in the workforce because they have more confidence their kids are going to be in school.
Well, we've been all around the block here. We've had lots of great questions. So I'm going to ask in these last few remaining minutes, if you could share with us, one of the things we'd like to ask you typically at the end of the town hall is, what sort of keeps you up at night? What are you thinking about? What are you wrestling about as you're thinking about your job in formulating this thing called U.S. monetary policy?
So one of the tensions we're dealing with here at the Fed is we're in the middle of another resurgence in the virus. I mentioned earlier, as a result, third quarter GDP growth is going to be weaker. The big thing that keeps me up at night is trying to decipher, is that a more fundamental weakening, or is this likely to be more temporary? And is the economy in fact continuing to make progress? I think it's more likely the latter. And the reason that's a real tension is, again, the longer, in my view, that we employ these extraordinary purchases of treasuries and mortgage-backed securities, and run the economy at a higher number of RPMs, revolutions, it makes it more likely that we might have to take more action on the Fed funds rate down the road. And so from a risk management point of view, that's the trade-off that is keeping me up at night. I'd like to see us at the earliest opportunity make adjustment to these purchases. And I think we can do it in a manageable way. And I think it will serve us well as we continue to manage through the recovery through this year and next year in terms of managing the Fed funds rate. So if there's one thing I'm thinking about and agonizing over, that's the issue.
Yeah, you have a lot to be thinking about. Are you hopeful?
Yeah, I'm very, very, very hopeful. And what I'm hopeful about, the one thing about the COVID is each of us is responsible for decisions for ourselves and for our own health. But if I've learned anything through this last 18 months, it's decisions we make individually affect the whole. And we've never seen that more clearly than today. And if we're going to pull through this, I think it will be well served if each of us has that attitude. We make decisions for our own health and personal liberties, but each of our actions affects the whole. And to the extent we all band together, we're going to come out of this better and have a healthier, stronger, more prosperous economy.
Great. Thank you, Rob.
Thanks
for taking the time to share your thoughts with us. And I want to thank the audience for your excellent, thought-provoking questions. The Dallas Fed is committed to engaging with communities and sharing information broadly and hearing what's on your mind. So thank you for participating this evening. If you want to learn more about the Dallas Fed and the things that we're doing, I ask you to check out our website, dallasfed.org. And while you're there, you might want to opt into future public town halls and our speaker series, Global Perspectives. once again, thanks you so much for joining us this evening. We hope to see you in the future. Have a good night.
Thank you.